You opened a brokerage account, you put in your first $500. You felt amazing, like you were finally doing something smart with your money. And then, you lost it. Not all of it maybe, but some of it. And nobody told you why it was going to happen. Today we're going to fix that. I'm going to show you the exact reasons most beginners blow up their investing account and what you need to do instead. Let's get into it. Here's the truth. Most beginners don't actually know what they're buying when they invest. They see a stock trending on social media. They hear a friend say, "I made money on this," and they jump in. That's not investing, that's gambling. Real investing starts with understanding. And understanding starts with asking one simple question. What is this company? How does it make money? And why would it be worth more in 5 years than it is today? If you can't answer that question in plain language, not with charts, not with technical jargon, then you don't actually understand what you bought. And if you don't understand it, you will panic and sell the moment things get scary. Which brings us to the biggest mistake of all, but we'll get to that in a second. Let me give you a real example. Imagine you buy shares of a solar energy company because you heard solar is the future. Okay, maybe it is, but is this company actually profitable? Does it have debt? Who are its competitors? Is it growing or shrinking? You don't need to be an expert, but you need to know the basics before you put real money into anything. Warren Buffett, one of the greatest investors of all time, has a rule he calls his circle of competence. He only invests in businesses he actually understands. Not every business, just the ones he gets. Copy that rule. Before you put a single dollar in, be able to explain what the company does to a 12-year-old. If you can't, don't invest yet. Learn first. Reason number 2, you let your emotions make the decisions. This one is responsible for more lost money than almost anything else, and it happens to almost every beginner, including people who know better. The market drops. Your portfolio goes from $1,000 to $820 in a week. Your stomach sinks. You start thinking, what if it keeps going down? What if I lose everything? And then you sell. You lock in the loss. And then, because the market almost always recovers, the price goes back up and you missed it. This cycle has a name. It's called buying high and selling low, and it's the opposite of what you actually want to do. Here's why it happens. Your brain is wired for survival, not investing. When something feels dangerous, your instinct is to escape. That's great when you're running from a lion. It's terrible when you're managing a stock portfolio. The market is designed to test your patience. It goes up, it goes down, it goes sideways. And during the scary parts, it feels like the world is ending. But look at any long-term stock market chart, like the S&P 500, and you'll see that every single crash was eventually followed by a recovery and new highs. The people who made money weren't the ones who predicted the bottom. They were the ones who didn't panic and sell during the drop. So what do? You have to separate your emotions from your decisions. A few things help. 1. Stop checking your portfolio every hour, seriously. If you check it 10 times a day, you'll react to every wiggle. Once a week is plenty for most people. Write down your investing plan before the market crashes. Why did you buy this? What's your timeline? What would have to change for you to sell? Write it down when you're calm. Refer to it when you're panicking. Zoom out. Open a 10-year chart of whatever you're holding. See all those scary dips? The ones that felt like disasters at the time? They look like speed bumps now. Emotions are part of being human. But in investing, the person who controls their emotions wins. Full stop. Reason number 3, you treat the stock market like a casino. There's a version of investing that looks like investing but isn't. It's called trading, specifically short-term trading. And for most beginners, it's a money trap. Here's what it looks like. You buy a stock. It goes up 4%. You feel great. You sell and take the profit. Then you buy another one and another one. You're making trades every day, sometimes every hour. This feels exciting. It feels like you're doing something, like you're in control. But here's what's actually happening. Every trade costs you. Even if there's no commission, you're paying something called the bid-ask spread, the tiny difference between the buying price and the selling price. Do that hundreds of times and it adds up. You're competing against algorithms and professional traders who do this full-time with millions of dollars in supercomputers. You're at a massive disadvantage. And most importantly, Studies show that the vast majority of active traders underperform simply holding a basic index fund. The more trades you make, the worse you usually do. There's a saying in the investing world, time in the market beats timing the market. That means staying invested over a long period beats trying to guess when to buy and sell. It sounds boring, but boring wins. There's nothing wrong with being excited about investing. Just channel that energy into learning, not into making 20 trades a week chasing quick gains. You found a company you love. You believe in it deeply, so you put 80% of your investing money into it. And then something unexpected happens. A bad earnings report, a scandal, a competitor announcement, and the stock drops 40% in a day. You've just lost almost a third of your total investment money in one day. This is what happens when you don't diversify, and it's one of the most common beginner mistakes. Diversification just means spreading your money across different investments. The idea is simple. If one thing goes wrong, you don't lose everything. Here's a basic way to think about it. Don't put all your money in one stock. Don't put all your money in one industry. If you own 10 oil companies, you're still very concentrated. Consider different types of assets: stocks, bonds, maybe real estate investment trusts. Consider different countries and regions. One of the simplest ways to diversify as a beginner is to buy an index fund. An index fund owns a tiny piece of hundreds or even thousands of companies at once. If one company crashes, it barely affects you because it's only a small part of the whole fund. The S&P 500 index fund, for example, owns a slice of 500 of the biggest American companies. You own a piece of Apple, Microsoft, Amazon, and 497 more, all in one simple investment. It's not flashy, but it works. Diversification is the only free lunch in investing, as they say. Use it. Most beginners start investing with excitement. They've read a few articles, watched some YouTube videos, opened their account, made their first purchase. And then, the market does something weird, or it just goes sideways for months. Nothing seems to be happening. And they start to wonder, is this even working? So they stop adding money. Or they pull out and say they'll come back when things make more sense. This is one of the most expensive mistakes you can make. Here's why. There's a concept called compound interest, and it might be the most powerful force in personal finance. If you invest $200 a month starting at age 22 and earn an average return of 8% per year, by the time you're 62, you'll have over $700,000. Not because you're a genius investor, just because you started early and kept going. If you wait until you're 32 to start, just 10 years later, that same contribution gets you to around $300,000. You've lost $400,000 just by waiting. The market rewards patience above almost everything else. Your job is not to be smart, it's to be consistent. This is why you need a plan before you start investing. Not a complicated plan, just answers to these questions. Why am I investing? Retirement, a house, financial freedom? What is my timeline? 5 years, 30 years? How much can I afford to invest each month? What am I investing in and why? Under what conditions would I sell? Write those answers down. They become your anchor when the market gets wild and your emotions start screaming at you to do something. A plan turns chaos into clarity, and clarity keeps you in the game long enough for the market to reward you. This one is sneaky. Nobody talks about it much. But fees and taxes quietly eat your returns over time, and beginners almost always miss it. Let me show you how bad it can get. Imagine you're choosing between two funds. Fund A charges 1.5% per year in fees. Fund B charges 0.1% per year. They both invest in the same things and get the same returns before fees. Over 30 years, the difference in fees can take away a huge chunk of your total wealth. We're talking tens of thousands of dollars, just because of the expense ratio. This is why low-cost index funds are so popular, not just because they're diversified, but because their fees are extremely low, sometimes just 0.03% per year. That's basically nothing. Now let's talk taxes. When you sell an investment for a profit, the government wants a share. How much depends on how long you held it. If you sell within a year of buying, called a short-term capital gain, you pay your normal income tax rate. That could be 22%, 24%, even higher. If you hold for more than a year, called a long-term capital gain, You pay a much lower rate, often 0% or 15% for most people. So every time a trader flips a stock quickly, they're handing a huge chunk to the government. Long-term investors keep more of what they earn. Also, if your country offers tax-advantaged accounts like a 401k, Roth IRA, or ISA, use them. These accounts let your money grow without being taxed every year. It's free money, essentially. Fees and taxes seem small in the short term. Over decades, they're enormous. Pay attention to them from day one. Let's bring it all together. Here are the 6 reasons most beginners lose money investing. Number 1, they invest without understanding what they're buying. Number 2, they let their emotions control their decisions. Number 3, they treat the market like a casino. Number 4, they put all their money in one place. Number 5, they don't have a plan and quit too early. Number 6, they ignore fees and taxes. The good news? Every single one of these is fixable. You don't need to be brilliant. You don't need a finance degree. You just need to slow down, learn the basics, and make boring, consistent decisions over time. The biggest edge you have as a beginner isn't knowledge, it's time. You have years ahead of you. Don't waste them making the same mistakes everyone else makes. And that's it for today's video. If this helped you, even just 1 point clicked, then do me a favor. Hit the like button. It tells YouTube that this video is actually useful, and it helps us reach more people who need to hear this. If you're new here, welcome. This is Money Science AR. We break down money, investing, and personal finance in plain, simple language. No jargon, no gatekeeping, no confusion. Just real information that actually helps real people. Subscribe and hit the bell so you don't miss any of our upcoming videos. We're covering everything from how to actually read a stock, to how to build your first emergency fund, to whether real estate or stocks is the smarter move right now. And if you have a friend or family member who's just starting to invest or thinking about it, share this video with them. It might save them from losing real money. Drop a comment below and let me know. Which of these 6 mistakes hit closest to home for you? Or maybe you've made a different investing mistake that's not on the list. Let's talk about it. I read every comment. Thank you so much for watching. I'll see you in the next one.